Okay, good morning, ladies and gentlemen. Welcome to Macro Ace with your host, Tony. We're going to be going through not only non-farm payrolls, but we've also got the Canadian employment data as well. Can everyone see me, see my screen clearly, hear me clearly as well? Let me know if you can't, and then I'll try and make any adjustments and then make that work for you. But we've got a lot to cover today, as said, especially that we've got Canadian employment data alongside the US employment data as well. So let's go through this here. So the non-farm payrolls data, what is it? So it is the net amount of jobs created in the prior month. And we have two surveys that makes up the employment report that we're going to be getting today. So we have the household survey, which measures the unemployment rate, asking questions to people about whether they're employed or not employed, part-time or full-time. And then we have the establishment survey, which surveys about 440,000 different businesses about whether or not, or how many people they have on their payrolls, and if they've added any new jobs to their businesses as well. So those are the two different reports that we have within the employment report. The establishment survey is the one that shows the net amount of jobs that are created in the prior month. And of course, as said, the household survey represents the unemployment rate. So how does it affect the markets? So for currency, usually when employment data is strong or at least above 400k, we see an appreciation in the dollar. And then for stocks as well, when we're not usually in a hiking cycle where we're expecting tighter monetary policy in a normal environment where there is an expansion in the economy, usually stocks would tend to see an appreciation as well. The reason being, of course, if there are more jobs created or more jobs added and there are more people that are employed, they in turn have more money to spend, and with the extra spending will lead to bigger corporate profits as well. The only downside can be is that if there are more jobs being added within an economy during a tightening cycle or just before a tightening cycle, what that could mean is that the Federal Reserve or a central bank could step in to try and hamper the strong growth that is being experienced within the economy. Usually, if there is more spending, that leads to higher inflation. And when there is high inflation, the central bank's job is to try and curtail that or to try and dampen down those inflationary pressures. So the employment data is a very significant part of inflation as well, and how that affects prices for consumers. So again, for stocks, it can be quite negative if there is a very strong jobs report. And for bonds, usually when in a normal environment, again, when there is a strong amount of jobs that are being added, that shows that there is a healthy economy, and traders, economists, and those in the government will view it, the economy is doing quite well. So for bonds, for bond traders, usually they would look for the economy to do worse, okay? Because what that would mean is that if the economy is doing worse, people would jump in to bonds, which would lower the yield that bond traders receive. Now, anyone before, let's say, the tightening cycle, or let's say before the economy goes down or goes into recession, before that, bond prices would be quite low if the economy is quite healthy. And usually you'd be in a risk-on environment where people would be trading stocks rather than bonds, because you would get a bigger return compared to a fixed rate that you would get within the bond market or holding a US Treasury security. So that's one thing that can happen, is that if we do get in a normal environment, if you do see bad employment figures or bad employment data, that bond prices could actually rally, and the yield on those bonds could see a decline. But in this environment that we're currently seeing at the moment, where the Federal Reserve has already tightened the monetary policy, has already raised the rates twice with a 50 base point hike that we saw this Wednesday, we've seen that the yield market or the bond market particularly in the yields, has seen a huge surge. And the reason why we've seen a huge surge in the bond market for yields is because when rates are raised, that also increases the yield on each of the bonds. Okay, so particularly the shorter term bonds, like your 2-year or your 3 and 6 month bills, would see a bigger appreciation compared to your longer term bonds. So if we go further ahead then, so if we go through our triggers, so now according to economists, they see a high estimate of 517k with a low estimate of 250k. And for the unemployment rate, they see that going to with a high estimate of 3.7% with a low of 3.4%. Average hourly earnings, so year on year. This I think is very important for not only the Federal Reserve but also for economists to keep an eye out for how strong are inflationary pressures at the moment and how well the economy is doing. So when we see that, so the Federal Reserve has mentioned in their previous monetary policy reports and statements and minutes as well, and also Powell in his press conference, that the job market is very tight at the moment, i.e. that there are a lot of jobs that are going around or being created, but that there are not enough workers to fill those positions. So usually what businesses will try to do is that they would increase the wages that those potential workers could get for taking a job. But at the moment, so that's why we've seen, an increase in the prior average hourly earnings when we go through and look through how well the economy is at the moment. But average hourly earnings is quite key to keep an eye on for if we do get stronger figures. That could mean the Federal Reserve could tighten monetary policy even further. The possibility of 75 base point hike, something that's not on the table and has been pushed aside by Fed's Powell, that could come back into play maybe later on down the line if inflationary pressures are still quite strong, and part of that being the average hourly earnings, and if there's a wage spiral that businesses and the economy faces. So again, the highest estimate that economists are looking for is 5.7% with a low of 5.4%. And for us, that's going to be quite a key figure, I think, to see how well the employment situation is within the US and how that could impact the markets as well. Then we have private payrolls with a high estimate of 490k and with a low of 280k. So before we go into the investment bank views, I think we'll go through what are the median expectations then from today's figures of what are economists are expecting. So for non-farm payrolls, the forecast is 380k with a prior of 431k. As said, remember, when at least 400,000 jobs are added within the US economy, that shows the economy is quite strong and employment is on the up. But if anything below that could show that there might be a bit of a contraction within the economy, or there might be a slowdown in job growth. So also for the unemployment rate, forecast is 3.5%, or pre-pandemic level unemployment is what economists are expecting, with a prior of 3.6%. And then the Canadian employment change forecast is 40k with a prior of 72.5k. Average hourly earnings or average earnings year on year, looking for 5.5% with a prior of 5.6%. Private payrolls looking for 378k and with a prior of 426k. So as said, the key bits of data then for non-farm payrolls is of course going to be the headline figure itself, the unemployment rate, and the average hourly earnings as well. So if we look to the investment bank views and what they see where they see non-farm payroll figures coming in and also the unemployment rate. So non-farm payrolls, according to JP Morgan, they are forecasting it to come in at 475k, with the unemployment rate at 3.5%. BNP Paribas, they forecast the employment data of non-farm payrolls to come in at 460k, with the unemployment rate again falling to pre-pandemic levels at 3.5%. And Bank of America, they see non-farm payrolls with a forecast of 450k. And again, same thing with the unemployment rate reaching pre-pandemic levels at 3.5% as well. Now, ADP employment that we had this week. So the data that we had for ADP employment, so in April, the labor market recovery showed signs of slowing as the economy approaches full employment, as according to Neela Richardson. And she added that while hiring demand remains strong, labor shortages caused job gains to soften for both goods producers and services producers. And as the labor market tightens, small companies with fewer than 50 employees struggle with competition for wages amid increased costs. So now, what is the difference between ADP employment data and the non-farm data? Of course, the first thing being is that ADP is done by a private company, and what it measures is it mainly measures the large businesses within the jobs market. And of course, what it doesn't do is it doesn't include the rural areas as such, what the official employment data measures. So some analysts and traders, what they do is they kind of focus on what the ADP employment data could be, and they see that as a way as an indicator or a leading indicator of what the non-farm employment data could be. But historically, there hasn't been a strong correlation where you see ADP see a decrease, and then you see the non-farm payrolls also seeing a decrease, right? So I think we've got to be careful. If you're looking at ADP employment saying, yeah, okay, employment slowed down, that's not necessarily going to mean that the non-farm payrolls data that we get today is going to show a slowdown in growth. Although economists are seeing that median forecast of 380k. We could get a surprise and we could get great data instead. But as said, investors, traders, and economists do keep a focus on what ADP is doing or what it's done in the week of non-farm payrolls to get an indication of what non-farm payrolls itself could be. So, indicators weighing on sentiment then and where the economy is at the moment. So, inflation at a 40-year high at 8.5% for year on year. The PC price index year on year, which the Federal Reserve looks at as their gauge for where inflation is in the economy, it was lower compared to the prior month at 6.6% versus 6.7%. So the key difference, I guess you got to understand with CPI is that it measures a fixed basket of goods for 2 years, whereas a PC price index, or the personal consumption expenditure price index, can chop and change, and it can measure what is seeing more inflation. So an example would be if chicken prices or chicken meat was, if consumers were going for more chicken meat and there was an increase in chicken meat prices compared to beef prices, then the PC price index, instead of looking at the beef price, would look at the chicken meat prices instead, whereas the CPI would stick to looking at beef prices. So in a way, the PC price index can be a better measure of where inflation is in the economy in its more so real terms, if that makes sense to you guys there. Is anyone kind of confused? If you're okay with what I've said so far, let me know. If you want me to go over anything again, do let me know as well, and I'll try and go through that with you. So moving on. So we had the core PC price index year on year. Again, another key inflation measure for the Federal Reserve was lower as well, at 5.2% versus 5.3%. Now, GDP was horrendous data that we'd received for Q1 in 2022. So the prior was 6.9%, but Q1 showed negative 1.4%. Now, we'll talk about the market reaction of that briefly, but what had happened was because the data was so bad and the economy was showing a contraction rather than showing an expansion, the Dixie, or the dollar index, had seen a decline. As so did the S&P 500. It had also seen a decline as well, off of the back of the really bad figure that had come out from GDP data. So what does that mean for non-farm payrolls? It could mean if you see that the economy is not doing so well, or if productivity has fallen off or fallen sharply, that if we do get really bad employment data, that we could see a similar reaction to what we'd seen with the prelim or the advanced GDP data. But again, that's what's going to make this more difficult to kind of gauge what the markets might do. But that's one thing I thought I'd just kind of mention as what had happened recently. So the unemployment, as said, 0.1 above the 3.5% pre-pandemic level. So we're getting closer to that there. ISM, Manufacturing Employment Index. So that also dropped as well to 50.9 versus 56.3. And we had initial jobless claims for this week, which came in at 200k versus a prior of 180k. And the JOLTS data that we had last time, it had shown 11.266 million versus a prior of 11.263 million. So JOLTS, what it does, it measures the amount of jobs added and lost as well. Whereas the non-farm payrolls data only shows the net amount of jobs that are being added. So, of course, non-farm payrolls itself is the headline figure, or the bigger, more important release, because the data comes out a week after the prior month has completed. Hence, it has a stronger reaction and a bigger importance compared to, let's say, JOLTS data, which is delayed and comes out way later than the employment data that we receive with non-farm payrolls. U.S. employment cost, again, quite key when we're thinking about average hourly earnings as well, at 1.4% versus 1%. And ADP employment change came in at 247k versus a prior of 455k, which was the smallest increase since April 2020. Again, like I said earlier, sometimes employment data is viewed as a leading indicator, but what we've seen today, that it's again what we saw earlier this week, is that it was the smallest increase since April 2020. So could that mean the employment data that we get today is worse than expected? That's a possibility. But as said, ADP employment measures private payrolls and the bigger companies rather than having a focus on the smaller businesses like the non-farm payrolls report does. Basil Chaco says, lots of value. Thanks for teaching. No worries. Good. I hope you enjoy what I'm sharing with you here. Okay, so Federal Reserve's view and their different views as well. So you have Fed's Powell, who said the economy is doing well and the labor market is tight, and that's evident with how the markets have reacted to Fed's tightening because of a strong labor market. And of course, wages and also average wages increasing because of that. And then Fed's Bullard, the most hawkish member of the Federal Reserve, who said that rate hikes will bring inflation expectations down and lowering inflation without harming the labor market. So he believes that the markets won't be affected, or that the labor market won't be affected by higher rates, which in itself, I think there's some truth in there, but I think more so, as said, if you increase interest rates, that means the cost of borrowing credit becomes more expensive. So for those businesses, if they're looking to borrow money to make the product or provide services, that makes it a bit more difficult to be able to do that. And in turn, that could lead to increasing the prices for the goods and services, which means consumers will have to pay more for those goods and services. So I think more so it's very, very hawkish that Bullard thinks that there would be little harm to the labour market with the rate hikes. Fed's Brainard said that overall the labour market and economy has seen very strong demand. And then if we look to views and sentiment, so if we consider the previous Fed Beige Book that we had, what it underlined is the firmness in the jobs market, and demand for jobs was described as strong, with persistent labour demand driving wage growth. Again, average hourly earnings is going to be quite key to keep an eye on for within this report, as it has been recently with other reports as well, such as the employment index, the employment indexes in the ISM data, and the employment costs that we've also received as well with the industrial production data for the US. Goldman Sachs sees about 35% chance of a recession from the Fed's efforts to control, tame inflation in the next 2 years. That was something that was put out about nearly 2 weeks ago now, but just something to be aware of how investment banks view rate hikes affecting the economy and how that could also affect the jobs market too. Also, you've had some other views as well from economists saying that historically, interest rate increases of the type that Powell is considering have resulted in recession. So Hazius from Goldman Sachs points out that 11 of the 14 attempts to slow inflation have left the economy reeling. So could we get a recession with these very strong rate hikes or bigger rate hikes or bigger and quicker rate hikes and tightening of monetary policy? Well, we're yet to see. But the stock market hasn't reacted to it very kindly, where we've seen market participants and traders pricing in these rate hikes, where we've seen the value of, let's say, the S&P 500 see a sharp decline over the recent month as well. So if we were looking at the S&P 500, if I just bring that up for you here, where the markets are at the moment, if I bring a bigger time frame, higher time frame, it's March 16th. So this is the S&P 500 on the hourly chart that I have, and February the 16th is when, of course, the first rate hike had happened. Can't see that too clearly. I'll zoom in, but we've seen that initial drop from the S&P 500 off of the back of the first Fed rate increase, and then the markets moved back up. But then later on, we had seen that there were expectations for stronger rate hikes rather than 25 basis point hikes that market participants were earlier looking for. So you'd seen this pricing in of the stronger rate hike expectations. And of course, remember, you also had the issue of Russia and Ukraine having an impact or negative impact on sentiment as well, where we'd seen a risk off reaction where people were more inclined to going into the dollar and gold, and also buying up of WTI crude oil rather than going into the more of the riskier assets such as the S&P 500 or corporate bonds or domestic currencies, i.e. Anything other than the dollar or the safe haven currencies. Of course, you had the rate hike, as said a couple of days ago, where you'd seen that 50 basis point hike to 1% by the Federal Reserve. Well, as said, the markets had already priced it in, so there was an initial move towards the downside, but there wasn't anything else surprising from the statement that shocked the markets. So there wasn't any further decline on the S&P 500. Rather, it reversed and then actually started to move back towards the upside here. Thursday is where we'd seen that the markets were pricing in of these rate hikes and tighter monetary policy from not only from the Federal Reserve, but also other central banks as well. Bearing in mind on Thursday, you also had the Bank of England, which won't really have an effect on US stocks, but more so sentiment of central banks still in that tightening mode. So this is why you'd seen Thursday yesterday, if you're kind of confused or befuddled as to why we'd seen a huge movement towards the downside or a loss of value on the S&P 500. That's the main reason. Pricing expectations for stronger rate hikes that are going to be coming up later in the year. Okay, so S&P 500, whilst we're looking at the charts here, currently down about 0.5% at the moment. If we're looking at the dollar index, or the Dixie, so with the Dixie near enough flat, but still in the negative territory, about 0.14 or 0.1% down on the day so far. If we have a look at gold too, gold slightly up at 0.3%. And then if you're focusing on Bitcoin, wow, Bitcoin is down by 2%. So don't forget, Bitcoin usually, of course, is considered as a risk asset and has reacted negatively to previous employment data in the past as well. But just to bear that in mind of where we are in the markets at the moment before we get the Nonfarm Payrolls data. So if we look at the previous market reaction, so this is when the data was more or less in line with expectation. It was above 400. It was above 400k, and what we'd seen is that with the solid jobs data, we'd actually seen an appreciation on the dollar, and we'd seen a decline on the S&P 500. So what does that mean? So one thing it means is that with the Fed talking about a strong jobs market and a tight labor market with wages increasing, because the data was there wasn't too much of a deviation from the forecast figure to the actual figure, it still showed that the job market was quite strong, and that the Federal Reserve could could tighten monetary policy further. So that was one explanation as to why the dollar would have seen that move towards the upside, and the S&P 500 had seen that decline. If we go to if I show the video 2 of the market reaction on here, the previous release that we had, I'll just mute that. But 10 seconds before the release, we got the dollar yen, S&P. We've got about 18 minutes, so I've also got to get through Canadian employment data too. So hopefully we'll get through this quite quickly. Okay, so data was slightly worse than expected at 431k versus the prior 490k. Average earnings was up. So that's, again, one thing that would have added to the negative sentiment for the S&P 500, where you would have seen, if inflation pressures in other areas in the jobs market was increasing, then you would see a negative reaction from the S&P 500. But the initial reaction here, as we'd seen, there was from the worse than expected data, there was moved towards the downside on the dollar yen, and there was an appreciation on the S&P 500 from that slightly worse than expected jobs data. So then, if I kind of skip ahead a little bit, so the dollar yen was still, and then the dollar yen had moved back towards the upside. As we can see here, as I'm kind of skipping through, we've seen the S&P 500, and also that the Nasdaq moved towards the downside. So one idea, or one scenario, could be that the markets reacted quite quickly to the negative jobs data, where we'd seen that flash move towards the downside on the dollar yen, and a flash move towards the upside on the S&P 500, and then the markets ignored the rest of the data and just carried on with their market movements. But I think one other thing to consider as well is that with the average hourly earnings, that was better than expected. That kind of added to maybe that negative sentiment or to the market, where it was much higher than expected, which would mean that inflationary pressures could be increasing, and if the job market is too tight, then we could see a wage spiral or wages spiraling out of control, where the Federal Reserve will need to step in to try and control that or hamper that extreme growth. So I think, again, it's going to be a bit more difficult to kind of see what we get today, but that was the last reaction from non-farm payrolls, was what we had seen. Okay. And so that is the non-farm payrolls data. Now onto the Canadian employment data. So let's go through. We've got, as I said, quite a bit to go through here. Actually, one thing I did want to go through is the deviations that I don't want to miss out for you guys. So the deviations for the non-farm payrolls data, as I said, there was a 59k deviation from the headline figure. So we've seen about 16 ticks towards the downside on the S&P, about 59 ticks towards the downside on the NASDAQ. That was overall. Dollar yen had seen about 5.5 pips towards the upside. Euro dollar about 8 pips down. Cable 5.5 pips up. Dollar CAD about 6 pips towards the upside. And Aussie dollar and the New Zealand dollar had seen the same reaction of about 8.5 pips towards the upside. Gold about 16 ticks towards the downside. The 2-year bond price had seen about 7 ticks down, and the 30-year bond price had seen about 10 ticks down as well. Okay, so that was the prior market reaction. So I think what we're looking for a stronger reaction, what we had seen in the past, is when there was at least when we actually started macro race doing this stuff, when there was at least a 300k deviation, we're expecting a strong market reaction. But now, so I think we're seeing stronger reactions with a figure or less of a deviation. So as you've seen, 4th of March, about 265k deviation. You've seen about 81 ticks towards the upside on the ES and about 6 pips towards the downside. And gold has seen about 23 ticks up. But I think would still stick to around that 250, 300k to see a good strong reaction that lasts for quite a while throughout the day. But as said, you have economists that are looking for around 200k deviation for them as their high estimate compared to the forecast, and what the actual figure is what they're looking for the high estimate. So around 200k for economists. I think for ourselves around 250, that 300k range deviation. The unemployment rate was also better than expected. Ignore the red. But yes, that was down by 0.1. Private payrolls was down the deviation was about 69k, and average hourly earnings was up about 0.1% for the year-on-year data. So now, going back to the Canadian employment. So employment change, again, measuring the new jobs that are added, including both full-time and part-time workers, and the unemployment measuring the number of unemployed as a percentage of the labour force. James Bowler says, do you share the sheets? Are you talking about the deviations? I presume that's what you're talking about. That's something that we can do. That's something I did discuss actually in the last release that I did. If you wanted to, instead of me going through it very quickly with you guys, you can have a bit more of a prep in that way to be able to kind of delve into the data a bit more. So that's something that I can do for the upcoming releases. Of course, we've got inflation next week with the US. Yes, the Excel sheets. Yep. Okay. So yeah, that's something that we can do and provide to our users. If you join the mailing list that we have, I'll put in that mailing list for Macro Race, and that'll be available for you guys to be able to have a look at that, to be able to sign up for that there. I'll copy that in now so we don't kind of forget. Well, thanks. Cool. Good. I hope it is useful for you when I do that. Same thing with the market reaction. Better than expected data will be positive for the Canadian dollar. For bonds, if you see the bonds, if you see better than expected data, what that could mean is that there might not be so much attractiveness to go to bonds, and instead you could see in a normal environment where yields rise and the bond prices fall. Of course, in this current environment, what we can sometimes see is as what I'd mentioned earlier with the bond market, is that if there is a stronger jobs report, then that could support the central bank's view for tightening monetary policy much more, and instead the yield could actually see a move towards the upside with the stronger report, and bond prices could see a decline instead. For stocks, usually in a normal environment, as said, better than expected jobs data can mean that corporations are making more profit in order to be able to add more jobs. But in this current environment as well, it could mean that with the stock market that you could see depreciation if again the central bank looks to tighten monetary policy further, and as I said, rate hikes don't favor the stock market so well, as of course that can decrease the amount of profits that those companies can receive from higher borrowing costs they would have to go through. So the previous report, you'd seen employment increase in both goods and services producing sectors, which was spread across accommodation and food services, and employment growth continues to outpace population as the labour market tightens. So where is the economy at the moment? So with inflation at the highest since 1991 at 6.7% versus a prior of 5.7%. GDP was also better than expected at the bank when we had the quarter finishing, the prior quarter, Q4, finishing at 6.7%. You've also got the jobs data as well. So 72.5k jobs were added in March versus 336.5k jobs added in February. Unemployment at 5.3%, so much better than a prior of 5.35%, which is the lowest on record since 1976. And then the recent data, you had Canadian GDP month on month at 1.1%. So the high estimate, or what economists are looking for, is the high estimate for the employment change at 125k, with a low of minus 51.5k. And they also see the unemployment rate with a high estimate of 5.5%, with a low of 4.9%. So sentiment and views. So you've also, as said, you had from according to Nova Scotia economist or Bank of Nova Scotia, saying Canada's forecast beating GDP data underlines the need for the central bank to accelerate the pace of rate increases beyond a half point increase, and that Q1 GDP is on pace for annualized growth of 5.6%. Bank of Canada forecasts first quarter GDP growth of 3%. So you have this difference in where the economy is doing much better than the Bank of Canada is forecasting. So once the central bank kind of catches up with expectations of where the economy is, they're quite slow. So it could mean that they further down the line that they could be quicker in raising rates and potentially by 50 basis points or even more, or by 75 basis points if that does come into the pipeline. Then BMO on April 8th, they said that the key takeaway is just how tight the job market now is, and the employment recovery is now complete, arguably more than complete. And that was according to Douglas Porter, chief economist, who added that we need tighter policy, which is long overdue. So again, for the stock market, if we see expectations being priced in for stronger rate hikes or stronger tightening of monetary policy, that doesn't bode well, as you'd see a depreciation, as we had seen recently with the S&P 500 as well, and how that's reacted to to rate hike expectations being priced in. So I think a lot of the sentiment now, both for the US and for Canada, is that the Ukraine-Russia conflict is depleted. The headlines that are coming through aren't having a reaction to, or not seeing a reaction in the markets. A lot of it is because the markets have become desensitized to the Russia conflict and are now more focused on central banks tightening monetary policy, and that's evident within the yields that we see in the bond market of the yields increasing and the stock indexes seeing a depreciation. So inflation and jobs data, or inflation, or price pressures and wage pressures in the jobs market is going to be quite key to keep a focus on now for traders. And that's what's pushing the overall sentiment at the moment so far. Of course, you do have the China lockdown issues. We've got about 5 minutes too. We do have the China lockdowns where we're seeing, well, we did see some negative reaction to WTI and also from the US indexes of a potential stronger lockdown in China having an impact. But I think that's being overshadowed now. Of course, we've got central banks and the Federal Reserve, particularly in that tightening mode, which is overtaking sentiment. Macklem said that once again, it will be highly unusual to see rates increase by greater than 50 basis points in one meeting, and a 50 basis point hike is basically locked in for the next meeting in early June. That's according to what CIBC Bipan Ray had said in some commentary. Investment banks, Citi sees 60k with the unemployment rate at 5.2, Bank of America 10k and 5.3%, and BMO 40k with unemployment rate of 5.2%. Then I know we've got not long left, so let's kind of about 4 minutes. So that was Canadian employment data. We'd seen Canadian employment data was slightly. Oh, if I kind of go back a little bit, I did miss. Try and get this right here for you. Okay, so the unemployment rate was much better than expected of 5.3% versus the prior 5.5%. Employment change was slightly worse than expected, but not a big deviation from the forecast. So what we'd seen from the markets is the Canadian dollar had actually appreciated. So we could see a similar reaction today from the Canadian dollar, where if the employment data is more or less in line with expectation and the unemployment rate is much better than expected, it could support the Canadian dollar initially. As we're seeing here, there was a reversal of that, looking back to the Canadian employment change being worse itself, where we'd seen the Canadian dollar see some weakening instead. But again, more or less, if we get data that's in line with expectation, we could see more of a mixed reaction from the markets, or where we could see a flash move towards the upside or downside, and then the markets kind of go back to normal. But deviation-wise, I don't want to miss that out for you guys. If we're looking at the Canadian employment data, okay. So Canadian employment data, what we've seen, so the employment change has seen about 7.3k deviation. So we've seen about 6 pips move towards the downside on dollar CAD, and then 4 pips up, and then 6 pips up on the CAD JPY, and GBP CAD about 9 pips down, and then we'd seen Euro CAD see about 8 pips down and then 2 pips up. So that was the last reaction we've seen. But when there was a deviation of 200k with the prior release, we'd seen a much clearer, stronger reaction from the markets, where the bigger mover, or the biggest mover, was GBP CAD. We'd seen about 33 pip move toward the downside off of the better than expected data, whereas where it kind of kicked ass in a way. Unemployment rate fell by 0.7%. So I think deviation wise, other than what the economists are expecting, I think if we're looking for the high end of 200k at least from the data, with the unemployment rate with at least a 0.3 deviation, we'd expect a stronger reaction from the dollar, or an appreciation from the dollar. Okay, so we've got 1 minute left. Let's go back. All right, it is release time, ladies and gents. Let's minimize that. Let's show up. Let's go financials there. Tick strike. Also, want to get that running too. Okay, I think I'll just do USD CAD. Get that running. 10 seconds. Alrighty. Dollar yen, 3 seconds. And Canadian employment much worse than expected. US non-farm payrolls 428k, higher than the forecast of 380k, and the unemployment rate for the US, if that's worse than expected at 3.6%, higher than the forecast of 3.5. The Canadian unemployment data in line with the expectation of 5.2%. Okay, let's see how the markets are reacting to this here. Okay, so we're seeing some movement towards the downside on the dollar yen. The S&P is seeing some movement towards the upside over here. I think deviation wise, that's so dollar CAD seeing some movement towards the downside here as well. So there's two business data that is affecting the markets at the moment. So you've got Canadian data isn't really moving. So the Canadian data was worse than expected at 15.3k. Forecast was 40k. Private payrolls much better than expected, 406k. Where's the average hourly earnings more or less in line with expectation? Quick check here. What are we looking at? Non-farm. Okay. Right. Okay, so that was about a 48k deviation on the headline figure for non-farm payrolls. So it wasn't a there wasn't a strong deviation for what we were looking for there. Still positive though. As said, the unemployment rate's in line with or worse than expected at 3.6% versus the price of 3.5%. And if we go to the Canadian data too, see much of a deviation that wasn't there. For Canadian data, not much of a deviation. There was 24k deviation or 24.5k deviation from the forecast figure. So not overall outstanding figures so far for, first of all, non-farm payrolls, the headline figure, and for the Canadian data as well. So I think from that data that wasn't way better than expected, hence we'd seen that negative reaction from the dollar yen and that positive reaction on the S&P 500. If I actually want to check the other currencies too, GBP/USD. I will also have a look at the other currencies against the Canadian dollar. Okay, so cable moved towards the upside there. Similar reaction to the dollar yen. Very choppy though. You'd seen that move towards the upside and then nearly tried to claw back or diminish its earlier moves towards the upside to go back to pre-trading levels. So more of a mixed reaction. As one thing I did kind of mention that we could get that if data is more or less in line with the expectation. So then there's no clear move at the moment. Dollar yen, S&P, let's look at the NQ. Same story there, it's still up so far. Oh God, dollar CAD is good luck whoever's trying to trade that. that just dropped and then went instantly back up. Right. Also the bond, gold, of course. Gold, similar reaction to it had. So it had actually gone past prior trading levels on the next candle of the data. Let's have a look at the bonds. Look at ZT. the 2-year. Okay, prices are up on the 2-year, but did see that initial move back towards near enough clawed back its initial move towards the upside, but it continues its move towards now it's continuing its move towards the upside. So still above pre-trading levels. Let's look at 30-year. It's 30-year. Okay, not as strong as a reaction as we'd seen on the 2-year. More so mixed from what I can see, just looking at the candle, where we would have seen maybe that initial move towards the upside and then the downside. Now it's moving towards, it's going back to its pre-trading levels as well. FX Burst says, why is this moving so quick? Well, like I said, I think the key thing is the data wasn't outstanding, and it didn't meet our deviations or market expectations for deviations. Excuse me, economists' expectations for deviations of the high estimate or low estimate. So more or less, yes, of course, it was better than expected, but not outstanding enough for a stronger move. First of all, from the dollar to price in a stronger rate hike from the Federal Reserve, and the wage prices are also in line with expectations. So that wasn't outstanding or crazy enough for the dollar to see an appreciation. And then, of course, the unemployment rate, although it was 0.1% lower, as I said, I was looking for 0.3 deviation on the unemployment rate itself in order to see a stronger reaction, or maybe more of a, as I said, a stronger reaction from the dollar there. But again, didn't get that there. So hopefully that kind of explains to you what's going on. Anthony says, is Brent oil correlated with CAD? Yes and no. So yes, the big yes is that during the Ukraine conflict, when we had seen crude oil prices seeing appreciation, we know that, of course, with Canada's economy, if I just bring that back up, or that presentation that I had, we know that Canada's economy, about 17% of their exports is from providing mineral fuels. So if I just bring that up here for you. So yeah, there we go. So about 17.5% of total exports is from providing or selling mineral fuels, including oil. So what we had seen previously, I don't have the chart up here for you. What we had seen previously is that when Brent oil prices had seen, or crude oil prices in general had seen an appreciation, the Canadian dollar had also seen an appreciation from stronger oil prices. Of course, that means those companies gain more profit with a stronger Canadian dollar. So that's what helped the Canadian dollar strengthen during that bit of sentiment of when everyone was focused on the Ukraine conflict. Of course, we're not seeing too much strengthening from the Canadian dollar now with the central bank, more so focused on the central bank on what they're doing instead. Does that kind of explain? There is a webinar or live stream video that I did do for the last employment change data, which did show that correlation between crude oil prices and the Canadian dollar. I'll let me find it for you actually, and that'll probably be much better than rather me trying to quickly say it for you here. Let me get it for you. believe it will be this one. Oh, yeah. Okay. That is the last video for the employment data that I did for Canada. And I believe I had that little chart there comparing the Canadian dollar against crude oil or WTI crude oil. But yeah, do have a look at that as well. Payment says, are US data good? So, for an economist, yes. So the employment data headline figure was better than expected. Okay, and as said, usually 400k or above shows the economy is expanding and then there is strong growth. But for traders, and particularly from how we've seen the markets react today, there wasn't a big enough deviation. As said, if we're looking at bring up the deviation again, there was find it here. The deviation was 48k, so it wasn't outstanding enough to see an appreciation in the dollar, and maybe some weakening in the US indexes. But economically wise, data barring the unemployment rate was better than expected. What numbers would have been ideal for dollar strengthening, says FXperts. We did go through that earlier on for investment banks we're looking at, but from our side, we were looking for at least 250 to 300k deviation in the employment figure itself. Economists were looking for around 200k or between 150 to 200k for deviation in the figure compared to the forecast figure, or the actual figure compared to the forecast figure. So I'm not going to say a specific number, but around that range is what economists and ourselves what we were looking for. So again, it wasn't that great or outstanding. Okay, so financial juice. Dun, dun, dun. This, if you were looking at it too, well, of course I've been showing it to you as well at the same time. Financial juice. Now, for a lot of traders, they don't have access to a Squawk service or voice and text service where you know what's going on geopolitically with different governments, or maybe there's geopolitical conflict, or central bankers are saying things that are that are moving the markets. This is the level that investment banks have. Okay, they have a Squawk service or with a voice, and they also have a text service too, which they receive. They use that because they know that with whatever happens, they know that news is generally going to move the markets. Okay, and we've seen that's been quite evident if you've recently seen the Ukraine-Russia conflict. Headlines of Putin saying that he's going to agree to invade or help the separatists in Ukraine and invade the Donbass region, where we've seen risk-off environment where the indexes had sold off. I'd seen the dollar and the safe havens seen appreciation, and WTI crude oil had seen an appreciation as well because of the risks that there's added risk in the commodity space. So that, as a headline, if you were kind of unsure as to why the markets were moving, then this is a place to be. This is a place to come where you can get the live, real-time news, real-time voice and text on your screens whilst you're looking at the markets react the way that they're reacting. Now, there are some, I'm going to put in the link here, but there are some other benefits of signing up to Financial Juice Pro. So that's the link for a 7-day free trial that we have for Financial Juice Pro. With the normal version or the light version, you get a 10-second delay. You get adverts playing as well. And the economic triggers here on the side, there's also a delay on that too. Okay, the economic triggers I'll explain in a little bit. But the best trading method is to not only look at the technicals of what's going on in the markets, but also listen in what's being said by economists, by politicians, and so on, to be able to, one, manage your risk in a much better way, and also, of course, in that way, you're managing your trade. And of course, there sometimes can be opportunities where you do get headlines about Russia going crazy, or the European Union, von der Leyen, saying that we can remove our reliance on Russian energy in 6 months, where the markets have a big old reaction or negative reaction. So that is something that I think is very key for traders. As said, you have investment banks that use it as a way to protect themselves from any risks in the market. So if I just show you the von der Leyen one, if you haven't used this feature, you can, but I'm just going to search for the von der Leyen headline. This week that we had, May the 4th, you had, as said, she said that we will phase out Russian supply of crude oil within the next 6 months and refined products by the end of the year. So this is a reaction of that headline. So on the dot, 2:50 a.m. Eastern Time, boom, you'd seen this nice move towards the upside on WTI crude oil. And you'd seen that appreciation there. That's one example of why news is very important to keep an ear out for or an eye on. You can use it both ways. You can listen into the audio, or you can solely just look at the text, whichever way you want to use it. The economic triggers here on the left-hand side. Now you can, so let's say for non-farm payrolls, what I was looking for, in order for me to jump into the market, or let's say buy whatever I wanted to buy, if it was the dollar or the S&P 500, I can manually just ignore those figures there. That's just showing you the forecast figure. So what you can do is you can manually add in your own triggers. So if I was looking for a 200k deviation, or a 250k deviation, or 300k deviation, let's say 580k would be my trigger to buy the dollar, to buy the dollar yen, if that's what I was focusing on, or to sell if I was looking at maybe 100, and if I was looking at maybe an 80k, or the data come in at 80k, then I can save that. And what it will do at the time of the release, of course it's not going to show it now, when the release appears, if it meets my triggers that I've set manually myself, okay, then it will either appear with buy or sell sign. So again, it's another way to another feature of Financial Juice that you can use for yourselves, and is another reason why it's so attractive. But I think that the other reason why Financial Juice is so great, as Trump would have said, I don't know why I did the Trump accent there, but it was necessary. Come on, guys, work with me here. But it's 24/5, okay, the news that you receive. So there's always somebody on the desk. And because somebody's always on the desk, you also have access to the news desk feature, where you can ask us questions, what's happening in the markets, or what's happened, or what to expect for later on in the day. If we're expecting an interest rate decision, what are markets saying? What are economists or investment banks saying? So that's also available to you too. So again, pro, no ads, no delay. You can get economic triggers that are in real time that you manually put in yourself. And also, we're cheaper compared to other competitors too. Okay, but as said, I've put in the link there for Financial Juice Pro, so you can have a further look into it and have a look through that there. Now, not only do we have Financial Juice Pro, but you've been looking at tick strike going off here at the moment. Oh, okay, markets have all right, that's done. They've reversed their initial moves. So tick strike. If you imagine yourself in the trading pit, okay, with the guys and girls, let's say it's the opening of the stock market in the US. You hear them start shouting, sell, 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 buy, 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 buy this much, buy that much, or sell this much, right? Tick strike is the audio and visual version of that. Okay, so what it does, it shows you the order flow that is coming through into the markets. So as we can see here, well, if we're looking at the 30-year bond and the S&P 500. Clearly, you can see there's some movement towards the downside here on the S&P. If I just show that there, there was some movement towards the downside on the S&P, and we could see that tick strike was corroborating that move, showing that there was some selling that was going on. Okay, so again, it's a visual and audio product that you can use as to kind of gauge, is as said, how much buying or selling that there is going on in that market there as well. Now, the other key feature with tick strike is that you can also set your level of sensitivity to wherever you want it to be. What that means, I've got it set to level 1 at the moment. So any if there are any moves that meet the requirements for tick strike or for that ticker to go off, then I will be able to constantly see that happening, right? Where there's a little bit of selling or there's a little bit of buying that is going on. Now, if I was to increase that sensitivity, okay, all the way to 15, what that means is I'm looking for stronger moves in the market or a stronger amount of selling or buying enough before I even consider looking at the markets. So that's what you can do. So if you don't want too many sounds going off, and you want to only see when there's a big movements in the markets, then you can set your sensitivity to that. Or if you want to see the markets continue, or if you want to see how much buying or selling there is going on continually in the markets, as we can kind of see here, there's more chops and changes. Okay, there isn't a defined, clear path of where the markets are headed. Then you can, if you're more in favor of that, then you can put the sensitivity to 1. So, ladies and gentlemen, if you would like a free trial of tick strike for 7 days, then you, my friends, can get it there. So if you click on that link there, you can sign up to a 7-day free trial of tick strike. You have a range of different tickers or assets that you can look at. So you've got your Forex, your crypto as well, your futures, your stocks, which we're adding more stocks to. You've got your ETFs as well that you can also keep an eye on too. But there are a lot of different assets that you can, and currency pairs and stocks that you can keep an eye on and see how much buying or selling that there is going on. How strong is it? That's a key thing. How strong is the move, or how strong is the amount of selling or buying that there is going on within the markets? Then you can sign up for the 7-day free trial, have a little play and see what works for you. If your question is, why do we have tick strike on the website? Well, that there has sensitivity of 6. So that's non-adjustable. So, it's only when there's, maybe there's slightly bigger moves happening, then maybe this will pop off and make some noise. But if you want to be able to adjust your sensitivity and refine your trading method, or help refine your trading method, then the trial version, have a go of that. As said, also to mention on the Financials website, there aren't a lot of assets that you can look at, whereas the pro version of tick strike can do that. Okay, so that's I want to cut that sound off because that's hurting my ears. Okay, so that's tick strike. And finally, of course, macro race. If you guys found this useful and you want to sign up to the mailing list of what to expect for the week ahead, and then, of course, I think what we'd also seen is James Bowler was asking for the Excel sheets of the previous reactions that we'd seen in the markets. If you want to get that data, then sign up to the mailing list that already put in the chat for you to sign up to. Again, if you liked what you've seen, don't forget to also like and share this video, and also subscribe to our YouTube channel too, to stay up to date and also to be able to watch these videos back. Alrighty. Does anyone have any questions? Any thoughts? Or have I, Kurt B, said, yeah, I use it, keeps me updated. I think that's in regards to financial user website. Anthony gave me a clap of his hands. FX Bear, hopefully I explained how Tick Strike works. There is a video as well on that of more detail of how Tick Strike works. But there's also going to be some more. There's going to be some more webinars in the future to explain how Tick Strike works as well. So don't forget to, when those do come out, don't miss out on those as well. Other than that, ladies and gentlemen, thank you very much for your time. Hopefully you found it useful. And next week, as I said, we have inflation data from the US. That's going to be the key release for us next week. Oh, and of course, if you like what you've seen, don't forget to give us a follow on Twitter too, which is there in the link for you to follow us there. Alrighty, goodbye, ladies and gentlemen. Have a good Friday and enjoy your weekend.